Hey guys, thank you for tuning in. So turns out Ashok Leyland is one of the hottest stocks in news right now, down 14% yesterday. I'm sure it has troubled a lot of people with short gamma positions. This particular script has a tendency to become very volatile around earnings and give big moves post results. And another problem we are faced with is that it gives whipsaws. One day it'll be down and the other day it'll recover completely. So if you've made any adjustments to the trade, it can prove fatal. It'll take away your profits or increase your losses. So that's another challenge. So I'm going to share how we managed our earning trade, what adjustments we performed, and how the overall thing turned out for us. So the results were to be declared by the company on 17th of July, but then on 9th the IVs were already very high. This is a script which stays around 35 IV, but on 9th we were getting IVs of around 46, which made it a script at 100 IVP, 100 IV percentile. So what we did was we added an ATM straddle, added a straddle at strike 135, and we thought, okay, if the IVs go further up, it's okay. There will be a tug of war between theta and vega, and if the script says sideway, it'll be difficult for vega to beat theta completely. So that's one of the risks we took, but we thought, okay, we were comfortable taking that risk. So in the coming days, even though the IVs went up, but they could not completely overcome the theta decay. So the position more or less remained neutral with a small profit. So the things were going more or less fine with the trade being close to neutral. But then on 16 July, the news came in that the government was planning to increase the load bearing capacity of trucks by up to 25%. And bam, Ashok Leyland fell from 130 to around 120 and later closed around 125. So being on 135 straddle, we were faced with a loss which was somewhere upwards of 10,000, maybe at one point above 15,000. So what we did was, in order to increase our break even on the downside, we added another straddle. We added this straddle when the script was around, I think, 122, and we added a 120 strike straddle. And we thought, okay, if the script stays between these two strikes, 135 and 120, so the IV crush would reduce that loss, and we would be able to get out. And even if it comes down, the 120 straddle would be there to save us to some extent. So now what happened was this position, which at day end was having a cumulative loss of around 15,000. Now this trade, the main objective of this trade changed from making a profit to minimizing the loss, and that is what we had in mind. We did not want to earn a big profit. Our initial and primary aim was to reduce the losses on this trade. In the past two earnings, the company has announced its results post-market, but this time the results came during market hours, and immediately post the announcement, shares surged upwards as the results were a little above expectations, maybe. So it went around 133, I think, and then it started coming back. And we sat there patiently because we've seen the nature of this share. It has a tendency to move in one direction and then recover back, and it traps you that way. So we were waiting mainly for the IVs to drop, and by the end of the day, I think the IVs had dropped to around 60 levels, which was a good 15% drop from the 70 levels we'd added our earlier 120 straddle. So we did not perform any management as the share was sitting at around 128.5. So we carried the trade to the next day as we were expecting more of an IV crush as the IVs were still very high. So at the end of the day, the loss had reduced from 15,000 the previous day to a mere 5,000, a good drop of 10,000 bucks. The next day, on the morning of 18 July, the script opened a little higher, around 129, and slowly started moving downwards. We had two straddles, 120 and 135, the midpoint being around 127.5. So it was good in a way for us that it was coming down. We wanted it to stay there for a while around those levels, and then when the IV got crushed a little more, we'd exit the position. But things don't go according to your way. So the script started falling sharply, and it was down 4%. Around 123, when we decided to exit the entire thing, take the risk off the table, and book that loss of 4,500 bucks we're seeing. What prompted us to take this decision was that we'd earlier seen that this script has a particular tendency to give moves in the opposite direction the next day. It has done this very often, and a lot of people get trapped in that. So we thought, why even take that risk? Why let it escalate our losses? So we took the entire thing off the table, took home a loss of 4,500 bucks, which was totally okay, considering the fact that at one point we had a loss of 15,000 bucks. And this proved to be an excellent decision later in the day as the script went down 14% and closed around 110. So had we held on to the position, it would have resulted in a major loss. And we were thanking ourselves that we took the good decision of booking it earlier. Now, the takeaway here is that the primary aim of getting into an earnings trade, if you're selling volatility, is to capture on the vol crush. Now, a lot of times scripts have a tendency to, go in a trend post earnings. They often give you an opportunity to exit with a vol crush, and it's up to you whether you take it or not. But in our experience, a lot of scripts give a post earnings thrust. It's called a post earnings thrust. That is, they get into a trend in one direction. And if a script gets into a trend, it's never good for a short volatility seller, especially if you're in strangles or straddles. Now, so if you've gotten volatility crush, if you're seeing profits on your position, it's always good to close them. We do not keep waiting for the script to give a move. When we have our volatility in our favor, when we have the IVs falling down, we exit. If they've gone in our expectations, gone according to our expectations, we are out of the trade. And it's often better to do it that way, get out with a small loss rather than holding on to the position and causing yourself to take a big loss. So that is how the trade went for us. We were able to reduce our big loss down to a small loss, and we're totally okay with that because there are a lot of other earnings where we've earned way more than this. And you can't earn on every trade. You have to take certain losses as well. That's a part of the game. But how you manage your risk, that's very important, and I think that should be the primary consideration you have while trading. Risk management tops it all. Thank you.